Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I will be taking over for Prakash going forward with regards to these Tuesday morning market outlooks. So we're going to keep things fairly simple today. We're going to take a review of the overall equity markets, take a look at kind of how different asset classes have been confirming a bit of a risk-on trading signal and taking a look at individual sectors that will give us a better sense for how the market is currently performing and what our outlook is as a result of that. So starting off with the S&P 500, what we've seen is a series of higher highs in terms of price. And we've been talking about this for the past few weeks, which is the fact that the higher highs have not been confirmed by higher highs in momentum. And on this rally here, what we have is a continuation of that negative divergence. So showing signs of exhaustion, showing some signs that this rally is in the late stages of its rally, which puts some concerns about a pullback into the $4,800 support level as a risk that we currently see with the current rally. The rally itself has been fairly narrow, meaning you don't have a lot of broad participation in this particular rally, which is generally speaking not a good sign. Certainly not a sign that this rally has a lot of strength. But we have started to see a bit of a broadening out of the rally here over the past week or so. Broadening out of the rally, meaning broader participation in the rally, is generally a good thing for rallies to see. However, it is only 1 week after what has been many months now of this continuing to get stretched, where higher highs in price on the S&P 500, including on the NASDAQ 100, is continued with lower highs with regards to momentum. So those are some of the concerns that we have here with the overall market, and the Russell 2000 is really the broader market that we're referring to that is starting to participate on this rally here over the past week or so. That largely has not been part of this rally here over the past week. You see Russell 2000 make a new relative high on IWM, being confirmed by momentum, showing us that there's some support here from the rest of the markets. So overall, what we're starting to see is kind of a rotation here, or rather broadening out of the rally, not just the growth names that are seeing participation here, but now value as well. As you can see, this is the chart of the growth versus value index. And what you see over the past week or so is that while equity markets made new highs, the outperformance came from value-based names, not growth names, and this is something that you want to see in order for this rally to have further upside. Is that the rest of the market needs to play catch up here. We're seeing a little bit of that here this week, or rather last week. And the question is whether that can continue. If that does continue, that provides a bit more support here for the current rally. If that can't continue, then that could still be a signal that the exhaustion that we're starting to see here over the past couple of months is still going to play out here. So that's primarily how I'm viewing the equity markets. When we look at GSG, which is the commodity-based index, we saw the breakout here at the end of last week. This is on the back of gold and silver and oil breaking out here, but we're starting to see commodities break out here. And we'll take a look at some of those charts here for gold and silver in 1 minute and take a look at a deeper dive. High yield corporate bonds. We've talked about this a little bit over the past few months, and we've talked about the fact that we've had this big rally here into high yield corporate bonds, followed by what has been a solid period of nearly 3 months of consolidation. And we're starting to see what looks like the early days of a breakout here to the upside. Now, this is a fairly strong risk on signal here for the overall markets, as high yield corporate bonds showing some strength here, showing that there's still appetite for investors to be taking on further risk at the moment. VIX, trading closer to the 13 handle as the S&P 500 makes a new all-time high, confirms that the overall investors are not particularly fearful. There's not a lot of demand, if you will, for put protection as equity markets reaches new all-time highs. That kind of speaks to a fairly low level of stress that the market is feeling as the market is reaching those recent highs. Taking a look at 10-year bonds, we see that the 10-year bond yields continue to decline actually after topping in around this 4.3% area. Certainly looks like it could potentially target down to this 4.0 area here on 10-year yields. So as we get yields to pull back here, that also provides a little bit of support here for equities to continue moving higher. We look at TLT bonds, long-term government bonds. We see that continuation higher here, starting to break out a little bit to the upside, so showing a little bit of strength here in longer-term bonds, another form of a risk-on indicator that we currently see here from the bond markets at the moment. Taking a look at the US dollar, we see that the US dollar has now started to trade in a sort of a range-bound motion, somewhere in the between 1.325 and 1.5 around there on the US dollar. So kind of as interest rates start to moderate, we start to get a bit of a range-bound opportunity here for the US dollar. For those of you that are currency traders, that simply means that the opportunities in currency markets may be diminishing here at the present moment here, with the US dollar trading kind of more sideways. Looking at gold, this is the one that we were referring to last week. At the end on Friday, we had this big breakout here to the upside, puts us into that 2100 trading range here, and we'll have to see kind of how gold starts to play out. It's been trading between 2000 and 2100. At the moment, I would say kind of a range bound is probably still more likely, but if we do see that breakout above 2100, that really starts to put a further upside here in terms of gold back to new all-time highs, back into position. So this is going to be useful for those of you that trade gold miners, mining stocks. Definitely going to outperform here with gold starting to show some upward momentum here. You see the same upward momentum here on oil after breaking out from this base that it's been forming for the past nearly 6 months now. We've formed this base around the $78-$79 resistance level. We broke out above that on Friday. We'll see this week if this can continue moving higher here, but this starts to open the pathway towards $90 to the upside, $90 oil in terms of the West Texas Intermediate crude contracts. And this is not surprising given kind of the state of affairs in the Middle East here right now. That oil starts to tick higher here and break out from this trading range that it's been trading under since the breakout of kind of conflict here in the Middle East. Looking at sector rotation, this is really when we look at the sector rotation chart, there's been a fair amount of rotation this week. We saw a lot of the leading sectors start to lose some of their leadership here this particular week. Financials, discretionary, industrials, healthcare, energy. You still have materials here in the leading quadrant, and that's primarily the sector that's leading here right now. You certainly have technology starting to round the corner here a little bit, while communications is still underperforming. Staples is moving in the right direction. Real estate and utilities seemingly fizzling out a little bit with regards to their momentum, and still kind of fairly behind in terms of relative strength. So starting to see some rotation here in the markets, which is a good sign. However, the rotation so far hasn't been particularly strong, even though we are starting to see a little bit of rotation here from the underlying sectors. So taking a look at the sectors here, you have materials recently that has broken out to new all-time highs. And what we see here is that those recent highs have been confirmed with relative outperformance to the S&P 500. This is a fairly strong signal here for materials. I do note that most material names in this particular sector are not household names. Many people don't have them in their portfolios or necessarily even aware of what types of names are in the materials sector. So if you're looking for opportunities, looking for new trade ideas, Perhaps this is a sector that you may not be paying much attention to here today, where you potentially might find some ideas this week here in that specific sector. I talked about the fact that technology, even though we made a new all-time high in the ETF itself, we see that the relative performance here is poor. Meaning, even though it's making new all-time highs, it's underperforming the overall market, falling behind relative to the market. And this is the rotation that we've been talking about, that weaker sectors are actually seeing stronger gains than the strongest sectors at the moment. Same thing here with communications, as we see communications trade near all-time highs. The outperformance of communications have been incredibly strong here, but it's been trading sideways here to the downside a little bit over the past week or so. One of the places we are seeing that underperformance here is in regional banks. We see that regional banks that have a fair amount of exposure to commercial real estate has really started to underperform here over the past few months. And as you can see, not only on the absolute chart, but also on the relative chart, we see that underperformance for the regional bank ETF. And this is one of the places that I think is really important for us to continue keeping an eye on, is kind of this regional bank ETF and seeing how that's performing. Gold miners starting to see a little bit of performance here after that move here in gold, but overall still an underperforming sector. We might see some short-term outperformance here in gold miners, so pay attention to that for those of you that do follow gold mining stocks. Emerging markets showing a little bit of strength here over the past couple of weeks. You know, emerging markets has been a sector that has underperformed the S&P 500, but over the past month or so, we started to see a little bit of outperformance here on this move here to the upside, you know, from that $38 now into that $40.50 level here, emerging markets. If this strength continues, this is certainly one place that we could start to see some outperformance relative to the rest of the market. And lastly, but not least, home builders and semiconductors. These are two sectors that we pay attention to take a look at kind of where we stand on the overall markets. And what we have here is a continuation higher here in terms of home builders, and that has been confirmed with kind of recent outperformance relative to the S&P 500. So really showing us that home builders, showing some strength here from, a fairly foundational industry for the overall U.S. economy, reaching those new all-time high levels with relative outperformance is a fairly strong, I would say, signal again for kind of a risk-on environment for the overall markets. And lastly, semiconductors. Last Friday or the end of last week, rallying to a new all-time high, and also relative outperformance here as well. Not surprising, with earnings last week that we start to see the strength here from semiconductors will likely continue, especially the outperformance aspect of semiconductors. One of the few industries that are currently reaping gains from both revenue and earnings perspective on the back of the AI rally. A lot of other sectors are still kind of based on hype that they will generate substantially higher corporate profits as a result of AI, but semiconductors is really one of the few industries that have currently realizing those increased profits at the moment, and that's why it is the best performing sector here in the overall market. So overall, what we're seeing here is kind of more risk-on metrics here for the equity markets, coming from bonds, coming from commodities, coming from other individual industries. So paying attention to that will help you better understand how to navigate the current markets. But overall, we're seeing a better environment than we did last week. So with that, that covers what I wanted to share with you here today.